Bank of America first quarter results just out, and Leslie Picker has the details this morning. Good morning to you, Leslie.
Hey, good morning, Andrew. Yeah, Bank of America shares moving higher on these results. The firm posting $7.1 billion in net income for the quarter, or earnings of 80 cents per share. That's beating analyst estimates by about 5 cents per share. Top line came in above analyst estimates as well, slightly. Revenue growth was about 2% year over year. Net income was down about 12% in the quarter, which is something we've seen across all the Wall Street banks so far reporting this quarter. But before subtracting for provisions and taxes for Bank of America, earnings were actually about 8% higher. Net interest income, what banks generate from lending out against deposits, was up 13% thanks to higher interest rates as well as deposit and loan growth. In the release, CFO Alistair Borthwick noting, quote, net income increased by $1.4 billion versus the year-ago quarter, supported by strong loan and deposit growth going forward. And with the forward curve expectation of rising interest rates, we expect realizing more of the benefit of our deposit franchise. Card loss rate ticked slightly higher during the quarter at 1.53% compared with Q4, but is less than half the rate it was a year ago. So that's really evidence that the state of the consumer remains strong despite inflationary pressures from the quarter. 3 out of 4 divisions grew revenue during the quarter, with the exception being global markets. Sales and trading saw record revenue from equities, but a 19% decline in FIC, or fixed income currencies and commodities trading. As we've seen with the rest of the big banks, investment banking fees were lower at B of A as well, down 35% for the quarter. You can see shares now up more than 1% in pre-market trading, guys.
Okay, great. Leslie, stick around. Let's bring in another voice. Stephanie Link is with us, Hightower Chief Investment Strategist and Portfolio Manager, and a CNBC contributor. Nuance. That would be a good one, Andrew, for Wordle. Nuance would be good for. But my point is, everything, Stephanie, is nuance. So rates go up, the deposit business should be great for banks. But then you worry about, the Fed slowing the economy, and then you got credit worries and everything. So which is it? It's like everything else. There's all these stocks they're bifurcated. Are there good banks to buy when rates go up? Are there banks to avoid when rates go up? Or all of them do well?
Well, they should do well in general when rates go higher. Bank of America is very levered to interest rates, especially on the Fed funds and the shorter term rates. Wells Fargo as well. In fact, every 50 basis point increase for Wells Fargo in Fed funds equates to 16% in earnings and 7% to net interest income. So there is a lot of leverage here. I think you have to step back, Joe, right? Because I think we've seen all the banks so far post good numbers in terms of trading, net interest income and net interest margins, as well as wealth management, and they've done a really good job on expenses. The big question, and what you're asking, is, are we headed into a recession, and is housing going to roll over, because clearly these companies have exposure there, or is it a soft landing? Is it above trend growth, and is consumer going to stay strong? The one thing I would say that we have learned from companies so far is the consumer is super strong. In fact, JP Morgan, I read the transcript again over the weekend, and they talked about how the consumer is in extraordinary shape, and that the companies in general, in terms of deposit growth and credit growth, it's up substantially. So the consumer's in good shape. The question you have to ask yourself is, can they stay in good shape? And I would argue that I think that they can.